You are sitting for an examination, and you are asked to calculate what should be reported as cash and cash equivalents. You are confused which to include or not. In this video, we will kill that confusion. Stay tuned.
Hello classmates. I am VMate, your virtual classmate. If you are new to my channel, please subscribe and smash the notification bell next to it. Don't forget to like, comment and share.
Chapter 1. Cash and Cash Equivalents. I divided this topic in two parts. For the first part, we will be discussing these items, and the rest will be in the part 2 video. Let's begin. To better understand the meaning of cash and cash equivalents, let us split this in two words. First is cash. Cash is simply money. These are coins and currencies. But in accounting, cash is not limited to money. For instance, when you receive a check and presented it to the bank, it will be immediately in cash to you. Therefore, cash includes money, a negotiable instrument acceptable by the bank for immediate credit or deposit. This is the tricky one. What is meant by cash equivalent? Or better to say, what is considered equivalent to cash? Here is what the standard says. Cash equivalents are short-term highly liquid investment. Did you get that? Let me simplify it for you. Just ask yourself of these three simple questions. Does the investment has maturity date? Was the investment acquired 3 months or less before maturity? Is the investment easily convertible into cash without significant change in value? If the answer to all these questions is yes, then the investment is qualified as cash equivalent. So, let's have the illustration. Using the given data, let us use the three questions analysis to determine whether or not the investment is qualified as cash equivalent. Let's analyze. Does the investment has maturity date? Was the investment acquired 3 months or less before maturity? Is the investment easily convertible into cash without significant change in value? Note, none of the criteria are met. Therefore, the preferred stock is not qualified as cash equivalent, but rather an investment equity. Let's try another one. Using the previous example, but this time, the preferred stock has redemption date. Let's analyze. Does the investment has maturity date? Was the investment acquired 3 months or less before maturity? Is the investment easily convertible into cash without significant change in value? Did you see the difference? This time, all the criteria are met. Therefore, preferred stocks with redemption date and acquired 3 months before maturity are qualified as cash equivalents. Let's have one more, but this time, a bit tricky. Does the investment has maturity date? Was the investment acquired 3 months or less before maturity? Is the investment easily convertible into cash without significant change in value? Oops! One of the criteria is not met. Therefore, preferred stock with acquisition date of more than 3 months before maturity is not qualified as cash equivalents. Here are the common list of cash equivalents. To save time during examination, it is recommended to familiarize yourself with the following items. The keyword is 3 months or acquired 3 months before maturity. Additionally, here are the common items included in cash. Make sure to familiarize yourself. I'll leave it to you. When we talk about cash, we are referring to unrestricted cash. But what if the cash is restricted? Should you still report it as cash and cash equivalents? Or how? First, here is what the standard says. Let me simplify it for you. Just ask yourself, is the cash restricted? If the answer is no, then report as cash. But if the answer is yes, then ask yourself further, Is the cash restricted for use or settlement of obligation for more than 12 months after the balance sheet date? If the answer is no, report as cash. But if the answer is yes, report as non-current asset. Remember, the classification of cash fund always follow its purpose or related liability. Therefore, if the purpose is current, report as cash and cash equivalents under current asset. But if the purpose is non-current, report as long-term investment under non-current asset. Bank overdraft. The cash in bank is said to be overdraft when it has credit balance. This occurs when there is an issuance of checks in excess of deposits. In this case, the account is classified as current liability. Using the given example, the overdrawn of $1,000 in X bank is presented in the financial statements under current liability. On the other hand, the $10,000 debit balance in Y bank is presented in full amount under current asset. Again, offsetting is not permitted. As a general rule, bank overdraft should not be offsetted against other bank accounts with debit balances. But there is an exception to the rule. When there are two or more accounts in the same bank, if the amount of overdraft is not material. Using the given example, this time the company has two accounts in X bank. In this case, offsetting is allowed. Therefore, the amount to be reported under current asset is $9,000, the net amount. Compensating balance. This is the minimum amount of deposit that must be maintained in the bank. Using the example below, of the 1 million loanable value, the usable amount is $950,000, net of compensating balance. The $50,000 compensating balance remains in the bank as partial payment. For classification of compensating balance, if the compensating balance is not legally restricted, report as cash. But if it is legally restricted, report as current asset if the related loan is short-term, and non-current asset if the related loan is long-term.
If this video is helpful for you, please support my channel, share to your friends and spread the knowledge. Thank you for watching.